Hi, this is Vijay Bambwani and I'm glad to be back with you. And this time, let me start by thanking you for all the feedback that you've given me. These videos are for you. The entire exercise is to help you become better traders. So when you give me your feedback, it pleases us no end. Everything is welcome. Your suggestions for what you want in our future videos, your appreciation, and even your criticism is all welcome. This particular video is dedicated to the request that I have repeatedly received from my viewers and subscribers about how to place stop losses on your trades. Stop losses, as we all know, enable us to basically limit the amount of setback that we are willing to take. But is it really as simple as that? I think not. Stop losses are of various types. And as Warren Buffett says in his annual meetings, he is often asked the question, when do you exit a stock? His answer is very simple. We invest in Berkshire Hathaway, we invest in a stock when the underlying reason that convinces us to invest is present, and we exit only after that underlying reason is no more present. So the stop loss that you place will also depend on the reason why you entered into the trade in the first place. So I go with few types of stop losses and I clarify on what kind of stop losses you can place when. If you're a day trader, the first thing is that time is your stop loss, which means in the equity market, which opens at 9:15 a.m. and shuts at 3:30 p.m., in the currency market, which opens at 9 a.m. and shuts at 5 p.m., and in the commodity market, which opens at 9 a.m. and shuts at 12 midnight, the market closing itself is your stop loss. Day traders like to go flat out, which means square up their positions no matter what, whether it's a profit or a loss. And just like the ECG of a dead person shows a straight line, you go flat out irrespective of the outcome. On the other hand, there are certain types of traders who are called micro trend traders. Now, these are traders who typically do not allow a trade to last beyond 59 minutes and 59 seconds by the stopwatch. So in such a case, the 1 hour time limit is also your stop loss. You may have a query about what happens if the trade neither hits a stop loss nor hits a target price in that 1 hour period. The answer is very simple. The reason you kept a time stop was to exit at that time duration. If you like the trade, by all means exit when 60 minutes are over, reinitiate the trade. That keeps you under check and lets you stay within the emotional parameters and disallow you from getting extremely aggressive in a trade. I understand that exiting and re-entering a trade entails costs. Nobody would know better than me because I'm a very cost sensitive trader, as I have talked about in the trade efficiency ratio video. You need to keep your trading and execution costs low, but a time stop is a time stop. So I've tackled two kinds of time stops: for a day trader, end of the session; for a micro trend trader, 60 minutes. Now let's take the other kind of stop losses. If you're beginning the session, we all want to make profits, but it is super critical that the day's first trade results in a profit. That sets you on the right foot. You're basically cheerful, your confidence level soars, and then you can trade the remaining part of the day with increasing amount of ease. However, if the first trade is not a profitable one, make sure that you do not lose any more than 2% of your capital, or as we professional traders call it, your float or your bank, which is the amount of money that you've set aside and put in the account of the broker to enable you to trade. Do not lose more than 2% of your capital on a trade. On the other hand, if the first trade is happily a profitable one, your stop loss on the next one will be slightly unique. Now, this is a system that I follow. Feel free to differ. So if my first trade gives me a 5,000 rupee profit, on my next trade, my stop loss will be no more than allow me to lose more than 5,000 rupees. The reason is very simple. I'm willing to lose what I have made. But after having a profitable trade, I don't want to have a loss of a second trade which actually eats into my capital. I'm willing to go home with zero profit, zero loss, but after making a profit, I will not go home with a net loss. So I don't want to go out of pocket. The other kind of a stop loss, which is based on technical parameters. Remember what I talked about Berkshire Hathaway's trading investment philosophy. You have entered a trade based on a technical signal, which is a support or a resistance. If at all that signal is violated, you will enforce a stop loss and exit the trade. Since the very reason for entering a trade is no more valid now, you will shut out that trade. Another kind of a stop loss is a stop loss based on screen reading signals. I have talked about the volume weighted price window and the snap quote window. I will stick to the snap quote window right now. So if at all you click on F5 after highlighting any security, you will have a rectangular snap quote window on your screen. If you have entered long, because the last traded price is consistently trading above the average traded price, and you hold on to that position, as long as the price is above the ATP or the average traded price, you're in the trade. If the last traded price falls below the average traded price, your stop loss is hit. On the short side, you entered a short sell because the average traded price was higher and the last traded price was lower. As in when the last traded price rises above the average traded price, you hit a stop loss and you're out of the trade. The last kind of a stop loss is an event-based stop loss. If at all I have entered a trade based on a certain event, for example, the drone attack on Saudi Aramco or the killing of the Iranian general which occurred in January. If at all I have entered, hypothetically speaking, I have entered long on crude oil because Saudi Aramco was attacked by drones or General Soleimani was killed by a drone strike. If I have gone long, but I realize that the price is not rising anymore, so the event is negated. In that case, again, a stop loss is hit and I have no reason to stick around in the trade. So these are the various types of stop losses that you can keep. As you can see, a stop loss goes beyond the simplistic understanding of trying to get out with a loss. Various stop losses depending on various situations. Before I sign off for the day, let me remind you to click like on this video if you're watching it on YouTube. By all means, please share this knowledge by sharing this video with your family and friends. In the comment section, please tell me what you think about this video and what other videos you would like me to record for you in the future. This is Vijay Bambwani signing off for now. Till we meet again, please do take very good care of your trades and investments. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.